Huge stock market crash is ahead of us. Prepare for the big bubble burst. The stock exchange has been on the wild ride over the past year and a half after losing more than one-third of its value in a matter of weeks during the early stages of the COVID-19 pandemic. The S&P 500 is up nearly 100% since last March. Some people believe all this growth is just too good to be true, though as they feel the market is overvalued, that means a market correction might be on the horizon to bring prices back track. For the past 17 months, investors have enjoyed a historic rally. Since bottoming out on March 23, 2020, the broad-based S&P 500 has doubled in value. While we witnessed some healthy bounce-back rallies from a bear market bottom throughout history, we've never seen the benchmark index double from its lows in such a brief time frame. But such rapid gains within the wake of such economic uncertainty also raises the question, could a stock market crash be coming? Stick around to find out more, but before we do, please hit that like button to get 5 years of good luck. Moving on. The truth is that no one can predict exactly when a downturn will occur, how severe it'll be, or how long it'll last. That said, if you're concerned about an upcoming market crash, there are a couple of things to keep in mind. Stock market downturns are relatively common and often alarming, but they happen more frequently than you would possibly think. Corrections are more common than crashes. In technical terms, a correction refers to any time the market falls by at least 10% but is able to rebound. A crash is usually defined by a drop in the market by over 20%, and if it doesn't recover quickly, then we are officially in a bear market. Based on foretelling signs, they suggest a crash or steep correction will more than likely happen sooner than later. Perhaps the most concerning indicator that a significant decline might await the stock market can be found by closely examining the S&P 500's Shiller price-to-earnings ratio. The Shiller P/E takes under consideration inflation-adjusted earnings over the past 10 years. Understandably, the democratization of monetary data with the arrival of the web has helped to expand earnings multiples considerably over the past 20 years. Nevertheless, the previous 4 instances where the S&P 500's Shiller P/E surpassed and held above 30 haven't ended well. In each of those instances, the index subsequently lost a minimum of 20% of its value. Examining the way the S&P 500 bounces back from bear market bottoms is also telling. Excluding the coronavirus crash, there have been 8 bear markets since the start of 1960. Every single one among those bear markets featured a minimum of one pullback of 10% within 3 years of reaching its bottom. In fact, 5 of those 8 bear markets endured 2 double-digit percentage pullbacks within 3 years of hitting a trough. The point being that bouncing back from a bear market bottom rarely leads to a line higher, as we predominantly experienced over the past 17 months. Historical data would suggest that the market is due for a few potentially significant downside. A quick look at historic crash and correction data for the S&P 500 paints a similar picture. Since 1950, the S&P 500 has undergone 38 double-digit percentage declines according to figures from market analytics company Yardeni Research. That's a crash or correction on the average every 1.87 years. While it's important to note that the stock market doesn't adhere to averages, it's still worthwhile to observe the frequency by which the S&P 500 pulls back by 10%. In other words, crashes and steep corrections are a wonderfully normal part of the investing cycle, and based on the above data, it shouldn't surprise investors if a stock exchange crash is coming. There's another side to this story. Another side to the present data must be told. Although stock exchange crashes and corrections are common, historic data also very clearly shows there are advantages to staying the course as a long-term investor and buying great companies on any weakness. For example, the investing landscape technically offers no guarantees. Yet each crash or correction in history has eventually been erased by a market rally. That means long-term investors in the S&P 500 would be 38 for 38. If they bought during a crash or correction, or simply held an S&P 500 tracking index since the beginning of 1950. What's more, Crestmount Research examined the rolling 20-year returns of the S&P 500 between 1919 and 2020 and found that the total returns, including dividends, for any end year during this stretch would have yielded investors a positive return. Only 2 of those 102 end years produced a mean annual total return of 50 or less. Meanwhile, quite 40 end years during this time frame yielded a minimum of a 10th average annual total return. Essentially, when you buy into the S&P 500, it's far less important than how long you hold. If you held your position for a minimum of 20 years between 1919 and 2020, your initial investment grew. It also doesn't hurt that the S&P 500 is comprised of 500 of the largest companies in the world. Its components tend to be profitable, time-tested businesses that are ready to cash in of the disproportionately long period of our time the US and global economies spend expanding relative to contracting. Lastly, note that while crashes and corrections occur often, they typically don't last very long. The average double-digit correction since 1950 has lasted 188 calendar days, whereas the typical modern-era correction is merely 155 calendar days. Comparatively, bull markets are measured in years. Well, I know no one can predict a market crash, but still, what do you guys think? Let me know in the comments section below. And with this, we've come to the end of this video. I hope you enjoyed watching it. Please make sure to like, share, and subscribe to our channel. Also, don't forget to hit that bell icon to never miss any updates from the Wealthy Brains.